Welcome back. Let's talk Palantir, and I've had some recent thoughts that I want to share with you. Way back when I spoke with Tom Nash, we were talking about, or it was mainly him explaining, this thesis that Palantir doesn't care about their stock, which is kind of funny. But it really is something that I've been thinking about a lot more recently. What does it mean? What does it mean for shareholders? What does it mean for the company? Is it even true? So I've been exploring this idea a little more, and it really comes down to the capital structure, I believe, of the company. But it also spills into the stock, of course. The stock has been languishing this past year since its run-up, which I think part of that certainly is that the stock tripled in such a short period of time. Something I'd like to remind people of is that Palantir listed, yes, just 1 year ago. What does that mean? Well, that means they had all their documents in. They valued the company at what they thought they would be valued at, where the market was giving Palantir a much higher valuation than they had even asked for. So certainly some backfilling to do. I would not have expected Palantir to necessarily move significantly higher after doing a 3x in just 1 year. But in this video, we're really talking about the future. So I'm going to go ahead and play this clip from my interview with Tom Nash, which was once again a while ago. So I think it is worth bringing up again. I'll be back with more analysis.
They couldn't care less about what happens with the share price. That's the thing.
Right.
The culture is we don't care about the share price. It's kind of opposite of how Enron used to be. We don't care. We don't care. We care about delivering results, and we honestly don't care if the share goes. The thing is, that's the whole idea of the Class F shares that allows them to basically say, well, hey, you can't touch us. We're untouchable, and we're going to do things the way we want to do it. And if you don't like it, well, have a soft drink. Pretty much. That's the whole idea of Class F shares. That allows guys like Peter and Alex and Steven basically to do whatever they want, not be affected by any short-term pressures by any shareholders of such or board members to do whatever. They cannot be touched. And here's the kicker. This is exactly what every Palantir shareholder wants. You can probably run a poll and you probably get over 85% of shareholders say that they want it this way. Not to mention that they were all informed that this was out in the open, and even, I mean, from before the DPO, everybody knew about that. It's like being a musician and doing the music you want and not the music that sells.
So a main piece of this is actually the financing that Palantir is using. Financing comes into play with stock-based compensation, which is employees and the executives, which you've heard so much about. I'm not going to talk about that at all, other than to say it's involved here. So there's debt and then there's equity financing. So Palantir is pretty much only using equity financing. Now, why is this a good thing, if at all? Well, some key factors here. Equity financing is best for new startups having high business potential. We would consider Palantir having high business potential. Whereas debt, which you'll recall, Palantir has actually paid off all of their debt. They're basically saying at this current point, they don't want to have any debt, which is a very interesting move. But I'll explain to you why I think they may actually go back into some debt in a moment. Debt financing is always beneficial when the small amount of capital is needed. Giving away equity for short-term needs is not a good decision. So obviously, debt financing involves borrowing funds from investors by issuing corporate bonds. Palantir at this point does not have any outstanding corporate bonds. The rewards here is interest income on the corporate bonds, of course. And moving on to equity. Equity involves issuing stock as payment, which causes dilution. The reward here is the dividend on the equity, except Palantir does not offer a dividend. So it's the return on the stock that Palantir is issuing. So let's break this down even further. So we have debt and equity, and then we have cost. Debt is a low cost, generally speaking, and equity is of a higher cost because of the dilution it causes. It causes these shareholders a lot of dilution because the pie is growing larger, as you've heard. So Palantir issues more shares, the pie gets bigger, your slice of the pie, in a relative sense, has gotten smaller. So why has Palantir chosen to do pretty much 100% equity at this point? Now, it really goes back to what Tom Nash was saying, but also there's still a lot up in the air, a lot that I don't understand, a lot that I would want to ask Palantir about. So at this present moment, again, correct me if I'm wrong, there's 0% debt and 100% equity in how they've been financing the business. Now, this is very peculiar. Why have they gone to such lengths to basically increase dilution in the wake of having so much cash? They have $2 billion in cash, and they're still issuing shares as a way to finance for the business. Financing for stock-based compensation for employees, for executives, and now, let's bring in another piece to the puzzle here, which is their new idea of the shelf offering. Now, granted, we don't know what this is for, if they will actually exercise the right to do this, but over the next 3 years, they have the option to issue more stock, but also introduce warranties if they want to, which would be debt. So my question is, what would they go to first? Well, given their history, I think they would go to equity and they would want to do that right away. But it's really weird how they've paid off all their debt, because I don't know of any other companies, granted I don't follow very many, that are in the stage Palantir's in, where there's still so much growth ahead, and they would rather incur a high cost to shareholders, dilute the company with equity instead of just choosing debt, even as a fraction of that percentage, of that total. So really there is a lot going on, but this shelf offering I think will give us some insight into what the plans are for Palantir. Had they paid down all their debt so they could introduce this? Was this part of a bigger plan? And is this really going to explain a lot? Or is it not? There's really so much we don't know, which is a risk, I will say that. I trust Palantir ultimately, but I don't think they've been communicating this well to shareholders. So again, this is something I've always been wondering. With $2 billion in cash, why would they possibly need to pay off all their debt and just choose equity? Now, let's tie this all together. What Tom Nash was saying about they don't care about the stock price. Now, that's great from an internal point of view, head down and working. But if they don't care about stock price, what do they care about? Well, they care about the company, making the company the best it can be, which ultimately trickles back to the stock price. So basically, they're saying we only want long-term investors. This is what Karp has said before, but it also means short-term investors will not do well with our stock. We're not focused on you. We're not focused on delivering for you. So they're focused on the long term. And I think even one of the recent interviews said they just don't even look the stock price, which is just great. And it's just not something you hear much about today. With everyone being so focused on quarterly reports, numbers, every single day the stock is moving up or down, the employees get distracted. It's just great to hear that sense of clarity from Palantir. So if that is the case, then I do have more trust in Palantir to deliver well for all shareholders that will be staying in the stock for years. I'm still a little troubled by the fact that Palantir doesn't want to hold debt, given that they are a growth company. Why are they 100% issuing equity instead of having debt be some percentage of that? They just paid down their debt, and their credit line, whatever you want to say about it, is much higher now. So if their credit is higher, they can get debt at a cheaper cost and more of it. They have stronger credit as a business. So the bottom line is that they don't care about passing dilution across to the shareholders because, and this is the key piece here, if they don't care about the stock price today, they care about the company today, which will lead to an increase in the share price in the future. That's just as I'm reading it. Of course, they went public so that their stock could be listed. They're not completely oblivious to their existence as a public stock. It's just that's not what they're focused on. And Tom Nash did a great job of explaining that. It's just tough to see it, especially when it's not entirely clear why the strategy is the way that it is. So I want Palantir to explain more about this, hopefully on the earnings call, which is coming up, which would be next month. Talked about this in my last video. Why has Palantir chosen solely equity over debt? And yes, I understand the advantages to equity. It's just kind of weird that they're not even using debt as an option now. They've paid it off. Is it really a good thing that they don't have any debt? Now, I think it's a great thing if your company is so mature that the stock actually benefits and the perception of the company benefits from the maturity of the company not having any debt, and they need to be able to fund themselves. And this also brings in the idea of what's another way to finance your company? You finance from cash. You finance from your retained earnings, because you are not paying a dividend. You are actually retaining your excess cash. So they can also obviously fund their business with cash, which they have been doing, but they've chosen to forego debt and completely paid it off. So I just can't wait to see the strategy here. I am sure they obviously understand the business way better than any of us and know way better than any of us what the future holds for the company, and they know what they're doing. I'm just trying to put the pieces together, and I'm struggling here. So I'd love to hear your thoughts in the comments. I want to know what you're thinking, what I've missed. I'm sure I made many mistakes, but a lot really is up in the air for me. I'm not doubting Palantir. I'm just trying to figure out what's going on. And is the new shelf offering playing into this capital structure here, if you will? I'm not trying to bring up the whole dilution argument again that has been talked about way too much, but it is a piece of this. So ultimately, I think Palantir not caring about the share price today and willing to do what actually hurts shareholders and drives the stock price lower is what many other companies fail to do or not are strong enough to do. If you can sacrifice today for the share price in the future, for the value of the company in the future, I think that really is a strength. And I really think that is something we need to appreciate as shareholders or will be shareholders or future shareholders, even if you do not own Palantir stock today. So I'll leave it there for now. Let me know what you think in the comments. Until next time.